So I want to highlight two questions. The first question says evaluate the likely economic effects of an increase in government spending, but it specifically refers to £23 billion on innovation and infrastructure. And the other question here says evaluate the likely impact of cutting tax rates as a policy to increase economic growth. It mentions income taxes and corporation taxes. These questions are from Edexcel, but they apply to Edexcel and AQA. Now, the point I'm trying to make here is to ask you guys, what policy is this? If I said to you the government were increasing spending on infrastructure, or if I said to you the government were cutting income taxes, or the government were cutting corporation taxes, what policy is that? Take a minute to think. So, what's extremely important to answer these questions is for you to understand that increasing spending is always a form of expansionary fiscal policy. And cutting tax rates is always a form of expansionary fiscal policy, right? Fiscal policy is the use of government spending and taxation to influence the level of aggregate demand in the economy. There you go, you've got your first chain. For example, cutting income taxes mean disposable incomes increase. This leads to an increase in consumer spending. This is a factor, a component of aggregate demand. Therefore, aggregate demand will increase. This can also lead to a positive multiplier effect whereby lower income taxes lead to more consumer confidence and more business confidence. Therefore, as businesses anticipate more demand, they might increase spending in capital goods in the economy, causing further increases in aggregate demand, right? In evaluation of how much it will affect economic growth, we can refer to the size of the multiplier effect. We know that the multiplier effect is determined by the equation K equals 1 over 1 minus MPC. Well, we can question whose income taxes are increasing, whose income taxes are decreasing. This mentions that the top rate of income tax was cut. Well, if a higher rate of income tax was cut in the US, well, these guys have a lot of disposable income. Therefore, they have a high marginal propensity to save and a high marginal propensity to import and a lower marginal propensity to consume. So if you cut these guys' taxes and their MPC is quite low, then the multiplier might be quite low. Okay? Now the second paragraph, this is where we need to think a bit differently from the standard answer. So all of these, hopefully you would have figured out, are also supply side policies. So a supply side policy is a policy that leads to an increase in the productive potential of the economy or an increase in the LRAS of the economy. Yes, it must be the LRAS, not the SRAS, if you're showing the effect of a supply side policy. Later, cost of production can fall and that can cause SRAS to increase. But if you're showing the direct effect of a supply side policy in the long run, then yes, you want to show LRAS increasing. What's different about supply side policies? Well, supply side policies mean that the economy can grow without experiencing inflation. And what are the downsides of supply side policies? Well, a lot of the time they've got time lags. The government might decide to spend 23 billion on infrastructure over the following 5 years. Well, there's a clue right there anyway, 5 years, but the improvement in the demand side will happen immediately because people will start working in the infrastructure projects. But productivity will only ever increase once the infrastructure is ready to use. Take HS2 as an example. The government have so far spent around £40 billion on it, but we can't benefit from the greater productivity and the faster trains because it's not ready for use. I then want to highlight a couple of AQA 25 mark questions. So we've got raising direct taxes in 2025. We've got increasing taxes in 2024. And we have got a few others as well, but Another one, 2023, a rise in corporation taxes. So there's a clear theme here, but I think the first examples that we went through allow us to fully answer this question. The key here to answer a full essay, a well-rounded essay on these topics, is just to understand that raising taxes serve as both a contractionary fiscal policy, and yes, they're not a supply side policy, but they have a negative effect on the supply side of the economy as well. As we mentioned before, increasing taxes. Now, if the question doesn't specify, say the 2024 one, it's great for you to specify. Say, for example, if the government were to specifically increase income taxes, disposable incomes would fall, therefore consumer spending would fall. This is a component of aggregate demand, therefore aggregate demand would fall, and you can refer to the negative multiplier effect and evaluate that using the state of the economy and the size of the multiplier as well. Now, the second thing here is that increasing taxes, especially income taxes, corporation taxes, are going to have a huge impact on the supply side. We'll pick one of them. So an increase in income taxes is going to decrease the incentive for people to work. This leads to a decrease in the number of hours people work, or an increase in early retirement, or an increase in migration out of the country. As skilled workers take retirement or move away from the country, this decreases productivity in the UK. This then reduces the amount that firms can produce at full potential, therefore reducing the size of LRAS in the economy. This has a negative impact not only on growth, but it also causes inflation, as it makes the economy more likely to experience a positive output gap. Evals, time lag, and then also this question is about reducing a budget deficit, and that's another major issue. There is an opportunity cost, so this is going to help the economy to reduce the negative downsides, of having a huge budget deficit and huge levels of national debt. What are they? So national debt means you have to repay all of the money that you owe, the accumulation of your budget deficits over the years, plus interest. For context, in the last couple of years, each year the government is spending around £100 billion on interest alone. If we were debt-free, we would have had £100 billion spare money just to spend on the NHS or education or infrastructure projects. Of course, to reduce national debt or to reduce the budget deficit, the only way is to decrease spending or increase taxes. However, the supply side policies, negative supply side policies, are actually going to reduce the chance of economic growth. And as we know, the more the economy grows, the more businesses profit and the more workers earn, allowing the government to increase tax revenue.